Hi friends, yesterday the MPC, the Monetary Policy Committee of RBI has come out with its policy decisions. So let us see why they have decided to keep the repo rate unchanged. In its first meeting of the new financial year 2026-27, Monetary Policy Committee of RBI has decided to keep the repo rate unchanged at 5.25%. The committee decided to wait and see how the West Asian conflict is evolving given the ceasefire declared yesterday. The retail inflation, also known as the consumer price index based inflation rate, for January was 2.7% and February was 3.2%. Because this rate was below the RBI's 4% inflation rate target, the MPC has decided to leave the policy repo rate unchanged even though concerns existed that commodity prices such as crude oil and gas price could push up the inflation rate. RBI expects the headline inflation rate to average 4.6% in 26-27 with the highest quarterly rate of 5.2% during October-December. The core inflation is expected to average 4.4% during the year. What is this core inflation and headline inflation? Whenever RBI says inflation, what they mean is headline inflation. In this context, the consumer price index based inflation is same as retail inflation, which is same as headline inflation. These three components, that is consumer price index based inflation or the so-called simple inflation, is a component of core inflation and non-core inflation. Non-core inflation consists of changes in the price of food and fuel. Why food and fuel? Because both of these commodities prices are highly volatile. Food price depends on factors like monsoon, and fuel price, as we are seeing right now, depends on geopolitical factors. Therefore, depending upon the non-core inflation, the headline inflation swings widely, which is not good from a policy perspective. Therefore, RBI separates out core inflation, which gives out a stable gauge to reveal underlying persistent price trends in areas like housing, education, and services. Please do note that RBI's inflation target of 4% plus or minus 2% is applicable to headline inflation rate, which is same as retail inflation rate, which is same as consumer price index based inflation. These three terms are equal. With respect to the Indian economy, RBI projected a growth rate of 6.9% in real gross domestic product for financial year 26-27. For the just concluded financial year 25-26, the National Statistics Office estimates a real growth of 7.6%, which means that growth for the current financial year will be slower than the previous financial year. In the current MPC meeting for making the inflation and growth projection, RBI assumed the prices of crude oil will be at an average of $85 per barrel for the financial year. If this price changes, then the projections will also go wrong. Additionally, along with the MPC decisions, RBI announced some business-friendly reforms like over 9,000 regulatory instructions are now merged into just 238 master directions, and similar exercise is carried out for supervisory instructions also. This reduces the confusion, cuts the paperwork, and lowers the compliance cost for regulated entities like banks. Regulatory instructions are set of binding rules that financial institutions must follow, such as capital requirement, lending norms, and KYC procedures. They carry legal force with penalties for non-compliance. Supervisory instructions are just guide or oversight processes like inspection protocols, risk assessment methods, and compliance monitoring by regulators. In conclusion, RBI has adopted a prudent data-dependent stance, pausing rate adjustments to await clearer inflation signals amid geopolitical uncertainties, while vigilantly safeguarding its 4% plus or minus 2% headline CPI target. Thank you.